My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job, not just to entertain, educate, teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Okay, there are two universes. Two universes, and that is the only way to explain this market's behavior. After a fabulous day where the Dow gained 240 points, S&P advanced 0.82%, and NASDAQ climbed 0.90%. I got to go there. I got to explain these alternate universes. There's the universe with the booming economy, and then there's the universe with the faltering economy. One of them is a fantasy. The other may be reality. But occasionally, they bleed into each other. A week ago, everyone was freaking out about a possible recession. Remember that? I mean, it was so frightening. The market was down gigantically. It was on the front pages everywhere. Since then, though, we've gotten a spate of incredibly positive earnings reports from gigantic retailers like Walmart, Home Depot, and now Target and Lowe's. So which universe is real? The robust one that we've seen this week or the teetering one that we visited a few short days ago? The one that had me on the Today Show urging people not to panic. When, once again, panic was the order of the day. Remember, panic is not a strategy. Let's dissect these two universes, please, because they're colliding here. And in the end, well, we know there can only be one, like the Highlander. The recession scenario that drove stocks down hard last week was all about the machinations of the bond market. Long-term rates had dropped below short-term rates, indicating a lack of confidence in the future, the dreaded inverted yield curve. This odd inversion always precedes a recession. It's a sign that the Federal Reserve, also which controls the short-term rates, has missed the mark. The Fed's caused many a recession. They know nothing! Sometimes they do it deliberately. Sometimes they do it by accident, which was the proximate cause of the Great Recession. If you buy this logic, we're inevitably headed for a recession. There's no avoiding it. The reason? The global economy is slowing, thanks in part to our trade war with China. The President of the United States has decided that it's worth taking a short-term hit if it means we can stop China from devastating American manufacturing, stealing American intellectual property, and spying on American citizens. It all seems so reasonable, doesn't it? The rest of the world really is having a tough time. The Fed really has been pretty clueless. Tariffs really are bad for commerce, even if I think they're sometimes unavoidable. With this line of thinking, you can wrap a bow around the impending recession. So you better stock up on Spam and Velveeta to prepare yourself for the fallout. As for the stock market, look out below! That's one theory. But now let's consider what happened today, where the averages rebounded back to where they were before the bond market induced panic, even as we hit inversion levels once again this afternoon. When you look at the causes, it really is like we're suddenly in an alternate universe. One smacks more of fantasy than a fact. This morning started with the earnings from Lowe's and Target. Both were strong enough to confirm what we'd already heard from Home Depot and Walmart. The consumer's in good shape and actually getting stronger. The tariffs, so far, they're a non-issue. A 10% increase next quarter is also viewed as a non-issue by these great merchants who can toe the line and squeeze suppliers because they're so powerful. How about price inflation? More like deflation. Traffic was way up. That's a classic sign that the consumer is flush. And as the quarter came to a close, well, guess what? The numbers accelerated. Lowe's made it clear that contractors in particular were spending more heavily, in part because ultra-low interest rates will spur more home buying or home equity loan-funded renovations. Thank you, Germans! We've got a phenomenal labor market, so homeowners were emboldened to invest in their houses, which are rising in value as mortgage rates come down. Executives at both Lowe's and Target talked about labor-saving technologies that help keep prices down. I've been saying this for years. The tech that comes out of Silicon Valley is inherently deflationary. That's why another reason Jay Powell can cut. As soon as we finished digesting these positive earnings reports, we heard from Brian Moynihan. Becky Quick interviewed him. Our own Becky Quick, always supposed to say that, on Squawk. And Brian's the CEO of Bank of America. He's their own CEO. And he told us that our long-term interest rates have plunged because of demand for U.S. bonds from overseas, not because of any economic weakness here at home. It's exactly what I've been telling you. If you're European and you're getting negative interest rates for owning 30-year German bonds, literally paying the German government to take your money, Why wouldn't you buy some dollars and swap into U.S. Treasuries? Even at 2%, the 30 years give you a much better return than you get, especially when you consider that Europe's got a currency that I wouldn't touch with a 10-foot pole. That's right, because the EU endlessly seeks to debase it. The truth is the Eurozone is a mess, dragged down by their commitment to austerity at any price. Thank you, Weimar Republic. But their weakness isn't hurting our economy. It's only pushing down our interest rates, which we heard from all these execs is good. In this bullish universe, the only thing holding us back is the fact that the Federal Reserve refuses to cut interest rates to levels that are more in line with the rest of the world. Even the tariffs aren't having much of an impact. So which universe is right? The one where our bond market is forecasting a dramatic slowdown, courtesy of economic weakness that we're importing from overseas? Or the one where the biggest problem, if you're a business owner, is finding enough workers in a red-hot labor market? It's funny. I'd love to say the optimistic universe is most likely to prevail. But the talking heads talk endlessly about how a recession is inevitable. I heard it all day. It's if not if, then when? Because President Trump isn't going to walk back his tariffs, and that chowderhead Jay Powell, has Trump called him a chowderhead yet, or is that tomorrow's tweet? Well, he won't cut interest rates fast enough, something the Fed minutes seemed to indicate when they were released earlier today. This kind of talk does sow fear, which erodes confidence, and without confidence, business pauses its new hires and its investments, which then leads to a downturn in consumer spending, which then leads to a recession. It's easier to spook people than it is to build confidence. It's one of the reasons why I don't like to do it. Making matters worse, the experts who fret about the yield curve don't seem to care what we're hearing from a Walmart or an Amazon or a Target or a Costco or a Home Depot or a Lowe's. To them, that's all anecdotal. Dismiss it, Jim. That's just your little thing with the companies. They take the yield curve instead as gospel. That's bonkers. Sure, it's inevitable that one day, I guess, we're going to have a recession. That's always true. The question is when. When the yield curve inverted before the Great Recession, it was at the end of 2005. Stock market didn't peak until the summer of 2007. That's not that helpful. And when all these major retailers tell us the consumer's in great shape, that's not a collection of anecdotes, for heaven's sake. That's empirical data. Look at my watch. That's right, my acronym for Walmart, Amazon, Target, Costco, and Home Depot. These companies canvass the behavior of probably every family in America. The ones who can't afford them go to the dollar stores, which are also booming. As for the trade war, Lowe's didn't even get any questions about the tariffs in the conference call because the analysts were tired of beating a dead horse, and Marvin Ellison did such a fantastic job. Congratulations on the first year on the job. So where do I come down? I think we could still talk ourselves into a recession, but the underlying economy is in great shape. If the president were to simply calm down the rhetoric on China, rather than taking them on like some sort of trash-talking wide receiver, the bears would lose their biggest crutch. I love it if all these wannabe economists who warn us about the yield curve would actually learn to trade bonds, but that might be too much to hope for. Bottom line, to borrow a line from FTR, we have nothing to fear but fear itself, and that fear is pretty darn groundless. Its source, angry rhetoric and frightening jeremiads from supposed experts who don't listen to conference calls because they believe they're irrelevant. So the next time someone tries to make you panic about the yield curve, keep in mind that they probably don't know what they're talking about. Bernie in Maryland. Bernie.
Booyah, Dr. Jim.
Oh, thank you, Bernie. What's going on?
This is Bernie from Abingdon, Maryland.
Okay.
Go Ravens. We'll see you tomorrow. Jimmy,
Ooh.
thanks for your guidance. Thanks for your guidance and advice over the years, Jimmy. But I got to say, you're also a great entertainer. And watching you every night really always puts a smile on my face. Thank you, my friend. I appreciate that.
Well, thank you. Look, I have to entertain to get viewers. I mean, look, if I could just put people to sleep and then I would have failed 14 years ago. What's going on?
Well, the stock I'm calling about is 31% below the 52-week high.
Okay.
It has a good history of beating earnings expectations, and it's expected to report increases on the top and bottom tomorrow. They have Chinese sourcing because they sell clothing, appliances, and computers. And, Jimmy, the CEO and CCO have sold shares over the last 2 months.
Okay.
Jim, in light of the good consumer data that we've recently got, and in light of the fact that I'm a club member at this place, the parking lot is always full.
Right.
Please tell me what you think of BJ's Wholesale Club, Jim.
Okay, look, all that is actually anecdotal, that the parking lot is full. I think that's fine. What I care about is that Costco's a better company, and these guys don't have the balance sheet that I want. So I'm going to have to say ixnay on the $22 name. It's just not what I want you to own. I mean, it could go up $3. How about Costco? I think it could go up $100. That's what we want. All right, I'd love to choose the universe where our economy is booming, not faltering. But the nattering nabobs of negativity, thank you, William Safire, are seeding enough fear to erode confidence. But please remember, most of the time they don't know what they're talking about. Mad Money tonight. With stocks heading higher today as recession fears faded, I'm talking to a CEO of a company that can offer real insight into how the economy is faring. Don't miss my exclusive with one we've never had on, Paycom. Then, confused about the proliferation of cloud software plays, you're not the only one. Join the club. Tonight I'm going over everything you wanted to know about but were afraid to ask. And Equinix's shares are on fire thanks to the digitization trend. As more companies store data in the cloud, I'm talking with the CEO, see how it's banking on the move. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.